Incap published its Q4 report today, and I have the company CEO Otto Pukk with me here at Inderes TV. Welcome, Otto.
Thank you very much, Antti.
Let's start with the traditional one. Could you describe Incap's performance in Q4 in terms of growth and profitability, and also the drivers that drove these two factors?
Yeah, no, we had an excellent Q4 as well, and excellent year last year, and had the all-time high in that sense result both in revenue and in the profitability side. And so first of all, I want to thank our team. It's amazing what our people have pulled off, and especially as the market conditions have not been that easy with the component availability and other challenges. So I'm very happy for that. If you look at what is driving that, I think it's the same mega trends we have been talking about before. There is electronics sector is growing, and if you look at the segments our customers are in that are very much into green energy, green mobility, and different IoT solutions, and so there has been a growing demand of that. And of course, part of that growth has also been that we have been able to deliver, and our fantastic team have been able to enable that for Incap and for our customers as well.
You said that the green energy and green mobility related customers grew a lot during the last years, and these two segments have obviously very strong outlook also going forward. Could you anyhow describe how much of your revenue come from these two segments?
Yeah, those two segments, we don't report it separately, but if you look at over 80% of our business is related to something green, in that sense, different kind of green solutions. Those two segments mentioned, but also smart homes and these kind of applications. So there's a lot of green in going through Incap.
Component availability is definitely improving this year compared to last year, which was very, very difficult in this front, and this obviously changes dynamics in the EMS industry. What kind of impacts can these changes cause on the Incap?
I think first of all, of course, it's positive that the component situation is improving, and we see clear tendencies to that now. That the lead times are coming down, and we have less delivery hiccups and surprises and so in the pipeline. So overall, it's a positive thing that the components are available in that sense. But of course, short term, as I mentioned, we have been able to facilitate the growth of us and also our customers through being able to deliver. And if now many players on the market will have components available, then I would expect that we will see on our end customer market some more competition. Will that affect the short term, in that sense, demand for their products? That's early to say still in the year. Also, I think in the industry in general, we have had been spoiled now with great visibility, and so that we already see is coming down from many of our customers, as there's no need to place orders a couple of years in advance now when component lead times are back to more normal 12 weeks and so on. And hopefully that won't mean that we go back to the 6 months that we came from, but perhaps something in between.
Could this mean also more price competition to EMS companies as your customers' market environment can be more challenging in the future?
Yeah, that's early to say. I think price competition and foremost, perhaps for the OEMs on that level can be if there's more players that have goods available to offer to the market, and then the competitive situation for sure will increase. Now, when it comes to EMS, I think we are quite transparent on with our customers what our value-added part is and what our margins is and so on. And I don't expect now that we should swallow any part of that or any, at least not any major part of that, because it's not a big margin business classically anyway.
Let's go then to India. The third factory is going to start production at the end of this quarter. But what kind of ramp-up curve should investors expect in terms of revenue and also profitability?
Yeah, no, in that, I think profitability side, we will produce a similar product mix that we do today. So I wouldn't expect that to vary more than, I would say, the normal variation that we have depending on what we are producing from month to month. We will move in the factory in the end of this quarter, so in the end of next month, and then start moving in activities and ramping up during the year that to come in that sense. And of course, with all investments, we have some spare capacity and so as well. So that we long term are aiming to fill. But I think there is already looking a couple of months from now, there is already be quite a lot of action in that factory. And then of course we have calculated in our steering when we say that we are 2023 gonna be higher in both revenue and in profitability or EBIT, then we have calculated that new factor already in that statement.
Okay, and then about M&A, you mentioned that you focus even more on M&A this year in line with Incap's growth strategy. How is availability of targets and their valuations nowadays in the EMS market?
I think there is still availability of targets, even if perhaps there is fewer now due to these possibilities of recession or recession on some markets and so. But what we see is that the valuations have come down, so the expectations are not that high as they were here some years ago, and that I think is positive. So perhaps it's a better climate to make a deal in that sense, that the expectations are more in level in that sense. So let's see. I'm quite positive when it comes. We have good pipeline and a team that we are working with them, and sooner or later I'm quite sure we'll land something that is suitable and value creating for our shareholders.
Incap's extremely strong growth has obviously tied a lot of capital to the balance sheet and especially the inventory. How do you look at your financing options? How much of credit capacity do you have available in the balance sheet, and what kind of other options you could have to finance these potential targets?
Yeah, and I think we have very solid finances and currently, and we have good possibility to finance a deal with many different tools in the toolbox, both through conventional loans and also raising capital or paying with shares or in different ways. So it depends on the case. And yes, we have tied up a little bit more cash in our inventories now during the component crisis, and so that I expect now during the year to come down to more normalized levels, so I expect our inventory to go down and free up some cash due to that. But overall, we have very solid finances. We are very little debt currently, and with good possibilities to finance an acquisition.
Thank you, Otto, for the interview, and good luck to this year.
Thank you very much, Antti.